Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Welcome, everyone, to the Millionaire Next Door podcast. Thank you so much for tuning in. We really appreciate it. Today, we're going to have a really exciting educational discussion. We're going to focus on the area of private equity, taking our deeper dive into alternative investments. And some of believe it or not, the public markets have been shrinking in size over the last years, and public or private equity has seen a lot of opportunities. So today I'm joined by a guest, Phil Huber. He's with Cliffwater. You may remember we did a previous interview with his colleague, Phil Hasbrook, also of Cliffwater, dealing with private debt. That was very, very popular, and I encourage you to listen to that as well. We'll put a link in the show notes as well. But I want to welcome Phil, and thanks for being here. It's great to have you.
It's a pleasure, Robert. Thank you for having me. Yeah,
for sure. Do you want to sort of give a really brief intro of yourself and what you do, and then sort of just launch into a kind of a high-level overview of what you were going to share with us?
That sounds great. So I actually joined Cliffwater just at the start of this year, 2024. So a little over 6 months now as part of the organization, but it's actually an organization that I knew quite well from my prior career life, which was I was actually on your side of the table for 16 years, and the bulk of my career spent on the wealth management side, most recently as CIO of a large wealth manager. And so what I joined Cliffwater to do is be head of portfolio solutions, which a big part of that role is centered around kind of product strategy, but also research and content. So basically ways to help advisors and folks that are using our products, help educate them around alternatives and private markets, and have them be more comfortable and confident allocating to these types of asset classes in their client portfolios. And so a bit of a history of Cliffwater as an organization. So we've been around, we're in our 20th year now as a firm, so a nice milestone anniversary year for us. We were founded by a gentleman named Stephen Nesbitt, who prior to founding Cliffwater spent about 15 years heading up consulting for Wilshire Associates, a large investment consultant. And so really founded Cliffwater with this objective of wanting to provide advice to institutional allocators, so private equity, pensions, endowments, sovereign wealth funds, foundations, those types of large institutions, and really focus that consulting and advisory business on alternative investments spanning private equity, private debt, real assets, and hedge funds. And so that was the firm for about 15 years, up until about 5 years ago when we started going into more discretionary asset management and developing funds that are really actually more oriented towards the wealth management channel, where we thought we could add more value in terms of leaning on the foundation that we had built in the private markets and alternatives world, and building products that were relatively straightforward and easy to use for investors that maybe don't have that same experience as these big giant pensions and endowments do when it comes to allocating to these types of asset classes, which introduce their own complexities relative to very easy to purchase a stock or bond, mutual fund or ETF. Historically, allocating to alternatives has been much more cumbersome from an operational standpoint, as well as being able to source and underwrite the types of managers in those asset classes. So the idea was to take all of that credibility that had been built over the couple of decades on the institutional side and translate that into solutions that provide comprehensive exposure to private debt and private equity for really financial advisors and their end clients. And so we started with private debt about 5 years ago, and we offer a couple of flavors of that. And then just this year, we launched our first private equity vehicle as well. And so the types of strategies that we offer are really focused on what we call evergreen or perpetual products. And so if you think about historically, there's been kind of this binary choice that investors have had in terms of allocating their capital, where it's been daily liquid investments, so mutual funds, ETFs, and that limits your investable universe to things like publicly traded stocks and bonds or commodities or what have you. And then you have the other end of the spectrum, which has been private equity or private debt or private real estate, where the ability to obtain exposure there historically has been more in what you call a drawdown vehicle or a limited partnership, where it's instead of an open-ended infinite life for the fund, it's a finite life drawdown type of vehicle where an investor commits capital, let's say $1 million to a fund. That capital is drawn over a 3 or 4 year period, and then subsequently they'll start to receive distributions several years later. But you're ultimately looking at a fund life of anywhere from, call it, 10 to 12 years. With that comes, a number of different actions or responsibilities that the investor has to bear. So they have to figure out to do with all that capital they've committed that hasn't been called yet, which presents its own challenges. Do you park it in T-bills? Do you put it in short-term fixed income or public equities, what have you? Which creates a lot of variability in terms of what the actual return experience looks like. Tax reporting is much different for taxable investors, and so limited partnerships have been K1 for tax reporting as opposed to more simple and straightforward 1099 that 40 Act products offer. Minimums have been historically very high to go directly into private funds, often $1 million or even higher. And I think the ability to find, again, within private markets, there's much wider dispersion of performance between, managers and what you find in the public markets. And there's a bit of an adverse selection component to individual investors or advisors that if they're getting directly pitched from a PE firm or something like that, it's often, maybe not the highest quality, because you start to think about, well, who all said no higher up on the food chain for these large endowments and larger pools of capital that maybe they couldn't get allocations from. And so I think that's ultimately what we and others that have entered the evergreen space for private markets are really trying to help solve for, which is we've spent 20 years understanding these asset classes, who the players are, building relationships, understanding the deep both investment and operational due diligence that's required to effectively underwrite these types of funds and managers, and then being able to harness and leverage those relationships and that expertise to deliver comprehensive solutions that provide diversified immediate exposure to private debt or private equity with a single commitment, relatively low minimums, ticker symbol execution at the major custodians like Schwab and Fidelity, and just getting broad access to these asset classes in a very, what we think is kind of a simple and elegant solution. And so we started with private debt about 5 years ago, and senior direct lending. That's probably what you had my colleague Jill Hasbrook on to discuss. About a year and a half or so later, we followed that up with what we call enhanced lending, which is also private credit, but just different flavors of private credit. Private credit's a big term. It encapsulates a lot of different strategies. The biggest of those is senior direct lending. That's what we do in our corporate lending fund. But really, this enhanced lending strategy was designed to be a complement to that provides exposure to, call it 10 to 13 sub strategies of private credit that are maybe a bit more niche or capacity constrained in nature, and trying to blend those together in a thoughtful way to provide a potential to offer a complete private debt allocation. And then earlier this year, as I mentioned earlier, with the launch of our private equity vehicle. And so the funds that we operate are called interval funds. And an interval fund is a semi-liquid fund, but it has a lot of the same features that you'll find with a mutual fund in terms of having a ticker symbol that you purchase with. The key difference with an interval fund relative to, say, a mutual fund is that you don't have that same ability to sell on a daily basis. Hence the name interval. It comes from when you set up the fund, you have the option to provide annual, semi-annual, or quarterly liquidity to investors. When whatever frequency you decide there, you are obligated to offer up to 5% liquidity on an ongoing basis. And if there are redemptions in a given period above that 5%, then investors may be potentially prorated in their redemptions, but an interval fund has to at least offer that 5% of liquidity for that frequency. And so that's been informative with how we've designed our products. Private credit is still illiquid, but it's more liquid than private equity. So we offer 4 quarters of liquidity in our private credit funds, we offer semi-annual liquidity in our private equity fund to account for the fact that it is just a less liquid asset class. And so, so we try to be thoughtful in that from the design standpoint. The other thing to consider for these types of solutions is that in terms of who can access them and who can't, private equity in particular has historically been really challenging for a lot of your kind of millionaire next door investors, to borrow your podcast name, where folks that maybe have 1 to 5 million or something like that in investable assets. Most private equity historically has been limited to what are called qualified purchasers, which basically the limitation there is you need a minimum net worth of $5 million, excluding your primary residence, in order to be considered a qualified purchaser to invest in these kind of limited partnership type vehicles for private equity. And so that really limited the universe of what types of investors could invest. What's been novel, I think, about interval funds and other evergreen structures is that they've brought that down to more of an accredited investor eligibility threshold, which still has some limitations, but it's much more broad in that there's really two main components. There's an income requirement, basically for single tax filers. 200,000 of income for the last 2 years is sort of the threshold, or 300,000 for a couple filing jointly. Or there's a net worth requirement of $1 million of net worth, excluding primary residence. And so investors have to qualify for one or at least one of those metrics in order to be considered accredited. And so that opens up the door for a lot more investors to participate in these asset classes.
Yeah, that's a great summary. There's so much there. Let me step back a little, kind of just for some listeners who may not have fully gotten that, but that was terrific. The title of the podcast is The Millionaire Next Door. I call it the overnight 25-year success story. So, I've been doing this 27 years now with second and third generation clients. So I've literally seen people that used to have 350K. Now they're, at $1.5 million, that kind of thing. They don't necessarily, not picking on them, but they don't have the sophistication to understand and invest as a institution, the Yale Endowment, the Harvard Endowment, sovereign wealth funds such as Norway's sovereign wealth fund. And you guys do. And we have a whole research firm, or research department, I should say. We've featured Sam Miller, head of our research, on the podcast. Joe Carey, he's the head of our alternative investments. Sometimes they may spend a couple years picking out a solution to these types of, and partnering and offering them on our platform. So we do a lot of the due diligence, and then we're there to really explain it at the level of the investor. Now we do have some higher net worth folks that have dealt with, at other institutions, have dealt with private equity, private debt. I mean, I have one in particular, just to point out, he has a fair amount of private debt held away at, one of our competitors. I looked through all the data, and in one case, that fund, which is substantially larger, is charging 44% more than you guys are charging. In another case, it's charging over 200% more, twice as much. I don't want to name names here. Performance is about equal, but there's twice the charges. You guys have done a really good job of keeping that manageable, and we track that as part of our fiduciary process. So we're looking a lot under the hood of what's going on, and then sort of filtering to let people know if it's applicable, if it's a new entry, what's best in class. We do have a lot of high net worth folks. We don't want something to go wrong in this space. So we do a lot of due diligence ahead of time, not to say nothing can ever go perfect, but I just wanted to frame that a little bit for folks so that they get that. And if they're new to this space, they may not understand it, but that's what we will guide them. Kind of like the shaman, maybe you're summiting Everest for the first time, right? You don't want to, or any time, you don't want to do it alone or come back down alone, right? So that's a bit of our role, but I'm going to turn it back to you to maybe follow up and keep going down this discussion.
Yeah, I think part of what we focus on too is we want our solutions to be very fair and reasonable from a fee and expense standpoint. So from a fee and expense standpoint, starting with something like direct lending, it's an asset class where what your upside is, it's your yield. And so your net returns are going to be a function of what are your fees and expenses and what are your credit losses. And that, in our view, because we're more of a consultant, we're not originating loans, we're not originating deals on the private equity side. Our view is let's take an open architecture, multi-manager approach to how we design these products. And that's beneficial to the end investor because they can get broad, comprehensive exposure to these asset classes where you do really benefit from having, exposure to a number of different managers. And what that also does for us is allows us to co-invest largely alongside these managers, where co-investments are one way to access these markets in a very fee-friendly way. And often for listeners that aren't familiar, a co-investment is functionally where a private equity sponsor or a private lender is making an allocation inside of their fund. And let's say they have a potential deal size of something like $100 million. They might have certain constraints inside their fund where maybe they can only allocate 75 million inside of that fund due to diversification reasons, concentration limits, whatever the case might be. And so they might have to farm out that remaining $25 to valued partners of theirs, valued limited LPs that they work with closely. And that's a way to essentially participate in an investment on a very fee-friendly basis. And that typically co-investments are direct company investments alongside the GP on a no fee, no carry basis. And that's one way to manage and mitigate fees. And if we think about our flagship private, corporate lending fund, that's about 2/3 co-investments today. So that's, to your point earlier, that's a way that we're able to keep our fees lower than a lot of our peers on that standpoint. And then we're trying to apply that similar philosophy to how we grow and scale our private equity franchise, and that over time we want to have a balance there between direct co-investments as a way to invest in companies on a more direct basis with a higher upside potential, but also keep our fees lower. And then the balance of our portfolio will be in largely secondary transactions where you can get potentially broader diversification more immediately because you're purchasing interest in an existing private equity fund later in its life. So there's not that blind pool risk. What assets are already in there. And there's also the potential, given the dynamics of secondary markets, to potentially acquire those interests at a meaningful discount to their net asset value. And so that's how we think about private equity, is having this blended approach of co-investments and secondaries and doing so across buyouts, which is the biggest part of the private equity ecosystem. But we also don't want to have no exposure to growth equity or venture capital, which are also meaningful parts of the private equity ecosystem as well. And so, I think we're one of the few, products in this evergreen private equity space that has that type of approach where a lot of our competing funds tend to be more focused in the buyout space. And even within buyouts, you tend to see a lot of exposure to what we'll call large or mega buyouts, which as you get higher and higher in transaction size, our view at least is, there's still a place for those types of exposures, but the return profile is going to be more and more similar to public equity markets. So whereas we want to focus more on the middle and lower middle market within the private equity buyouts, where we think there's higher return potential, more diversification. There's risk involved in that, and that these are smaller companies, but we think if you can be really thoughtful about manager selection, that you can, potentially add some value there.
Great. And then, I love that it does add a lot of diversification, right? And there are things I explain to folks, something like SpaceX, you might get something like that, and maybe you could give some additional examples, but other spaces that they're not going to get into. And this is combined with a normal portfolio, or maybe, you have publicly traded equities with lots of information and transparency, your debt, your bonds. But I love that for folks that qualify, what you described as that accredited investor, now they have some access. And part of me just feels we deal with a lot of higher net worth, but we deal with a lot of these millionaire next door, where I watched them come up over 25. I'm an example of that myself. And just taking a step back, I feel it's kind of unfair. It kind of ticks me off that a lot of people in society don't fly on the private jets or belong to this country club where those kind of deals are discussed. And they deserve it as long as it's filtered down and they understand it and it's appropriate, and they have expert, layers of insulation, like Cliffwater or other providers and ourselves to help guide them through that. So they deserve, they deserve access to the best medicine, to make an analogy, right? It's not like just the rich people should only be getting the best surgeons. Well, that may in fact be the case. But I just said a mouthful. Maybe you could talk about, give some examples, a little more context, maybe chat about some of the risk. Any other thoughts you have? I mean, this is
Yeah, I
super
think
helpful.
the way we think about private equity is it's equity. It's not this is not there's a lot of different types of alternative investments out there. What we've talked about already, private equity, private debt, but there's hedge funds, there's other things that are
Yeah.
designed to be more or less correlated and maybe not high as returning. Like our view with private equity is that belongs in an equity allocation. And if you think about the size of that marketplace today, I mean, public markets in terms of the number of stocks have shrunk considerably
Yep.
over the last few decades. It's much, there's more potential value to be created by staying private for longer. There's less incentive for companies to want to go public, just given the additional compliance and reporting requirements, and maybe the short-termism that can manifest inside of the public stock market. And so and a lot of M&A activity in public markets. So you've just seen that number of public companies shrink a lot over time. And I know, our founder, since he came from Wilshire Associates, he's used this analogy, which is there's an index called the Wilshire 5000, which
Yep.
was called that at one point because it had, roughly 5,000 stocks in it, and it hasn't had, 5,000 stocks in it for many, many years now. I think it's 3,000 something as part of it.
Mm.
If you look at companies in the US with over $100 million of revenue, about 90% of those are private, not public. And even just if you take global kind of market cap as your starting point from where to build an allocation off of, if you combine public equity market value, which is, I think, a little bit above 100 trillion today, and private equity, which is maybe call it 13 to 15 trillion, that's a decent chunk of the global equity marketplace in privates. And that maybe used to be a rounding error 10, 15 years ago when private markets were much smaller. So it wasn't necessarily an allocation decision that someone had to make when they were building a portfolio for an investor. It was more about, hey, how do I diversify between US stocks and international stocks, or large
Hmm.
caps versus small caps, or value versus growth? Those were kind of those different decision factors that would come into play. And as I look ahead to the future, I think, at a certain point in time, private versus public is going to be another one of those sort of levers that allocators pull when they're building an equity portfolio, where it's less about, hey, here's this alternative investment, which can mean a lot of different things to a lot of different people, but rather, hey, there's private markets, there's public markets, they're both very large in size. We want to have exposure to both of them.
Hmm.
And with that comes diversification benefits, where there's different, sector exposures, maybe less concentration, and particularly in today's, public equity market, where just a handful of companies represent about 30% of the, S&P 500, and a lot
Yep.
of, a lot of that broad market exposures in one or two sectors. You might get more sector diversification. And I think even too, what's happened is public markets have matured over time. They've gotten more competitive. And when things get, not to say private equity hasn't also gotten more competitive, but public markets are pretty efficient. And so the
Yep.
ability to outperform something like the S&P or the Russell 3000 has gotten more challenging. And if you look at active managers in public markets, there's just a narrower band of
Right.
over outperformance and underperformance. And so it definitely lends itself well to the idea of, hey, just buy the market and keep your costs low and index. Whereas in private markets, that's a bit wider. And if you've got a track record and a history of being able to select, top and, second quartile managers, that gives you additional room for outperformance potential. And so I think there's a number of cases and arguments as to why the Millionaire Next Door should and has the ability now to invest in private equity relative to years prior where they didn't. And that's evident if you look at the data on what allocations look like for individuals versus institutions. Institutions are actually in a position now, and we can get more into this if you want, where they've kind of filled up their buckets, and a lot of them are kind of in that 30 to 40% allocation across privates and alternatives. Most individual investors are at zero or low to mid single digits exposure. And with these institutions that are maybe a bit over their skis and relative to their targets, they're now in a
Yep.
position where they're not getting the level of distributions that they're used to fund new commitments, and maybe their governance policies around their asset allocation are forcing them to to engage in discussions around how do they generate liquidity to rebalance their portfolios back to target. And so that's created this sort of robust secondary market in private equity where there is a meaningful dollar amount and it's growing considerably of secondary transactions in private equity. And some of those are what they call LP led, where the limited partner in a private equity vehicle, essentially goes through some sort of auction process that's maybe brokered where bidders will come in and say, we want to purchase these interests from this LP at some discount to their value. And like anything in life, if there's someone who's in need of liquidity, they don't get to name their price. If if you're a liquidity provider, that can be an additional lever of value to be able to buy a set of assets for less than its intrinsic value. And so another growing area within the secondaries ecosystem is what we're calling GP-led secondaries, whereas as opposed to the limited partner, like an endowment or something like that, wanting to sell their interests, the GP is developing largely what are called continuation vehicles, where they might have one or several what they call high quality trophy assets in a fund that's nearing the end of its fund life. And they don't necessarily, at a certain point, these funds get so old that investors are demanding that liquidity and they want to wind down the fund. But the GP might not want to sell that company at an inopportune time where they think there's more possibility for value creation in future years. And so what they might do is create a new vehicle called a continuation vehicle, move one or more assets to that, give existing limited partners the option to either take liquidity or roll their interest in the new vehicle. Most historically have opted to take liquidity. But what that does is opens up the ability for new limited partners or new investors to then enter that continuation vehicle and potentially participate in whatever future value creation that company or subset of companies might have in the next, call it 3 to 5 years. And so you're seeing a lot of really creative liquidity solutions come to market to help solve this ongoing need for liquidity. And I think that creates opportunity for groups like Cliffwater and others that are deploying capital into private markets where the benefits of secondaries are multiple in nature and that they are typically, there's a dynamic called the J curve in private equity, where if you think about a new fund, a new vintage, where the first few years you're just having your capital drawn, but you're not seeing returns or distributions for several years following that. Essentially your net returns seem negative for the first few years up until maybe years 5 through 7 you start to receive capital back. That's hence the J curve dynamic, where it's a challenging exercise for a lot of folks when it comes to allocating to PE. And so investing in secondaries largely bypasses that J curve. You're buying assets that are closer to their ultimate maturity. And so when you're operating a vehicle like ours that offers periodic liquidity, that can be really helpful to have that, where not only are investors stepping into a highly diversified portfolio that's fully deployed, they're investing in assets that don't necessarily have that same time to maturity as they would if they were entering a brand new primary vintage vehicle.
That's great. I mean, largely to your point, there's a lot of expertise in your process. So people who are new or don't, they might not know where to enter on the J curve. That's part of your process to make that determination. And then to the point of public versus private, I think of a lot of companies are going private or they want to stay private. Why would you want all that information intensive disclosure, SEC? This is mid-July, late July as we're recording this. We're going straight through the heart of earnings seasons. So, every quarter you got to justify your, company misses by 1 point, a penny, they slaughter the stock. Just to another point, we talked Tesla. There's things like In-N-Out Burger, for example. I'm not saying that's in there, but anytime I drive past that place, it's pretty clear that place is making a lot of money and people love it. There's other restaurants all around it. There's some fantastic stuff, but guess what? They all go to In-N-Out Burger. I won't sit in the line of 200 cars. I just won't do it. But I knew a guy who years back worked in the treasury at McDonald's, and every time he would come out to California, when he flew out, first thing he'd do is go get an In-N-Out Burger. He loved it. And McDonald's was salivating. They would buy that thing in a heartbeat if they could, for example, or other places would. But they want to stay private, So I think about that. You guys can look at those kinds of deals, and we all know those kind of businesses that are just sort of, they just prefer to keep it quiet, run their highly profitable niche type thing, even it's incredible. And the AI, the wearable, I have a ring that tracks my sleep now. It's a Finnish ring. It's kind of a leader in the space. I don't know how to invest it. I had a function I was at. I met one of the greatest speed skaters in the world, who's a major Olympian, Apollo Ono, at an event. And then he happened to be mentioning, oh, he's an early investor in the company. I said, oh boy, I don't get access to stuff like that. So you may be seeing those kind of things. There's some really exciting stuff, and it opens up the playing field for what's possible. And we can still put allocations into the public markets as well. Such a great discussion, so much detail, maybe a little bit more detailed than a lot of our typical listeners might know, but that's the point. They have this process. We have a process around selecting partners. We partner with our clients, and our hallmark of our practice is really the process, objective, unemotional, rules-based, and putting a lot of professionalism behind that. So maybe we'll kind of start to wrap up and land the plane a little bit, but do you want to give some sort of closing thoughts or anything else you think folks should be thinking about, or points you want to bring up? And this has been just excellent. So thanks.
Yeah, I would just say that the relative to when I started in the business, the tools and the toolkit that
Yeah.
advisors have to build portfolios has changed dramatically, and I think for the better. I think the 2022 was, I think, a very eye-opening year for a lot of folks that thought the 60/40 type stock bond portfolio was bulletproof, because they had just been accustomed to this notion that traditional kind of core fixed income was going to serve as that portfolio ballast to your equity risk, and it was just it was very much, hey, if it ain't broke, don't fix it. And I think that opened a lot of folks' eyes to, okay, there are not everything, these correlation benefits between asset classes are not necessarily constant all the time. There's different economic environments where those relationships can change. And so you don't want to have this sort of two-dimensional approach to portfolio construction that relies on one source of diversification to your broad equity risk. And so we're in this kind of new age now. And I think this kind of, I think a really impactful time where there's a lot of opportunities to diversify beyond stocks and bonds. Some of that can be in private markets, like we've discussed today. There's other, types of diversifiers and alternatives out there. So I think, we're in a good position now where we can really build more robust portfolios that can withstand a wider range of market and economic regimes, and hopefully to the benefit of long-term outcomes for individual investors.
Yeah, that's a fantastic point. I mean, again, I've been doing this 27 years now, second and third generation. Just the evolution, the expansion of the toolkit. Not to say 60/40 is dead, that's something, but there's other layers. It's just like medicine or any other. They evolve. The cars today, are so what can be done? Or if you're a doctor and you're practicing 27 years ago, the tools you have where something can get analyzed by AI and an amazing report to help you do your job. That is really exciting. And then bringing it to folks who don't always understand. They have lives, they have families, they have businesses, they have other areas of expertise. Some of them are, surgeons, but they don't have time to study this space. So I really love that, seeing the expansion of the toolkit. And just to let everyone know, a big point of this whole podcast is to kind of take folks deep under the hood, show them what we're doing, but we're not satisfied with the status quo, the way everything, we're always looking to be better, to learn new stuff, to bring better solutions. We have a very highly and refined process that is very, very good and effective, but we're not satisfied that that's good enough. We're always trying to up the game all the time. And some of these partnerships and these discussions and these things that are coming around, I wasn't really allocating to the space a couple of years ago. I didn't understand it. I didn't have the tools. Now we do. So we're just trying to educate folks and partner and then get really good, trusted partners that understand that and evolve through that to their benefit. So your point's terrific. All your points are great.
Well, I think
Appreciate
too,
it.
just your mentioning of the 60 portfolio, like I've been asked that question so many times the last however many years because I have been so focused on the world of alternatives. People ask
Yeah.
me all the time, is the 60/40 portfolio dead? And when I tell them I no, they're surprised and
Yeah.
they expect me to say
Yeah.
that's really not the answer. It's more the way, the way we define the 60 and the 40 is just different. I think the spirit of
Yeah.
60/40 is this idea of you want balance in a portfolio. You want to have,
Right.
a component for growth and a component for income and diversification. I think what's evolved and what's changed is kind of what we slot into that 60 bucket, and that 40 bucket is really become more robust. And so
Yeah, I agree. And, the press was so quick to jump on it. If something doesn't work for 9 months, is it dead? But a year like 2022 really illustrates, where maybe some exposure to things other than equity or just normal public debt added a tremendous amount of value. So it just evolves and it's great. But we're there we call ourselves the noise canceling headphones to tune
yeah,
out a lot of the
that's good.
extraneous noise that everyone's following and, focus on the true message. And you guys are doing that as well. And not everyone gets that. So that's often just a really big value that we bring to folks. And is the 60, well, it's a really nuanced discussion, but here's how it applies to you. And we have partners who are helping, and we spend a lot of time trying to really dial in that process and improve it all the time. So you did this for I think you said 17 years, so you get it too, but we're trying to bring some of that institutional focus too, and some of that value and wisdom where they are just not completely excluded from that universe and shut out if they could benefit. And I think that's a really nice thing to do for folks. So I think that ought to wrap it up there. You're welcome to have a last word, but this is great. We need to do this again, dive down the rabbit hole. And I super appreciate you being on this, and look forward to sharing it. And this will be a great evergreen resource for folks in the future. Private equity, maybe they get it conceptually, but they really don't know. This is reliable information. If you like it, let us know. If someone could benefit by it, please feel free to share it. We really appreciate you being here, Phil, and the listeners. We appreciate you being as well. And thanks so much,
Yeah,
Phil.
no, we'd love to
Appreciate
come
it.
back. Yeah, we'd love to come back sometime and appreciate the partnership. So thanks for having me on.
Fantastic. All right, everyone. Make it a great day.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.